Hi, I'm Pattu from FreeFinCal. Finally, I've been able to calculate the XIRR or the annualized return on my overall equity mutual fund portfolio for retirement, and it's 2.75% after 12 years of investing. Well, 44 days short of 12 years of investing. My first investment was in June 2008. So, a quick look at what this means to my portfolio, my financially independent status, and the future goals, my future course of action for this goal. So, I initially thought my XIRR was about 10ish% after the crash, but then people in Asana Adhesive Wealth had said something is off, and I thought there was nothing. It's not a bug, but then my Excel tracker did not complete its iterations over all my calculations, and therefore I got that incorrect result. So it's now 2.75% as of 5th May 2020. It does not include my direct equity portfolio. My direct equity portfolio is about 9% or so of my mutual fund portfolio, and also I had done some transactions today for this month. I have not included that in this calculation. So in the current status is as follows. The equity allocation is 53.5%. This includes both equity mutual funds and stocks. The debt allocation is 46.5%. Out of this, NPS is the maximum with 82%, which is a mandatory government NPS, and PPF is the rest at 18%. And even in this PPF, most of it is my wife's PPF. So the overall XIRR for the equity mutual funds is 2.75%. I have not included the direct equity because it's just too young and to make a very big difference. It doesn't really matter. The NPS has been 9.3%, especially in the last few months because of the rally in the gilts. It has done quite well. I have a separate video on this 10 years of investing in the NPS. You can have a look at that. So, with respect to the individual mutual fund performance, HDFC Balance occupies 40% of my portfolio. It's got an XIRR of 6%, down from 11% in December 2019 when I did it for my audit. Parak Parak Long Term Equity Fund, 7.9% XIRR, down from 13.8% in December 2019, also occupies 40% of my portfolio. The rest is Quantum Long Term Equity. XIRR should be something negative. When I calculated, it gave me 0. That means I have to give a guess value of some negative number for it to iterate down to that negative return. But I didn't bother to calculate what it was, and maybe I didn't want to. So it was 7% in December 2019. It has fallen down negative now. So the point now is that I have some cash of about 6% of the total portfolio value. I might invest some of it. I'm not sure. I've not really thought too much about it. I've just let it accumulate in an SB account. I've not planned anything about it. I've just let it go. Excluding the cash, the total portfolio is 31 times my annual expenses. If I include the cash, it's 33 times my annual expenses. This means that I can live off this corpus for 33 years at zero real returns. Not bad. So the financial status is intact. It's not a very robust financially independent status, but it's all right. It's not so bad, I think. In spite of the crash, somehow I've managed to get that. So it is the 2.75% after 12 years definitely is a poor return. But then the point is that that's not the metric that you should be worrying about. I don't really care. As you can see, I'm not in a bad shape at all. And if you actually look at what the corpus is really worth, and that's what it really, that's what I've done, and I have shown how to do it in a post called Review Your Financial Freedom Portfolio in 7 steps. You can get the link from the post. Go to freefincal.com, go to this article, and head over to this link. Like I said in yesterday's video, YouTube is not allowing me to post new FreeFinCal links either in the description or in the first comment. A pinned comment is just not allowing me to do that. I can't do anything about it. So, if you know how to evaluate the value of your current portfolio, then you don't have to worry about the return. I would definitely not make statements like, if I had invested in an SB account, I would have got the same return today and things like that. No, equity gives you huge losses and huge gains. You have to go through that. It gives you an opportunity to get the huge gains. I got that opportunity in July 2000, late 2000, December, November 2013. After 5 years, my portfolio shot up, and my social status, or whatever you want to call it, was no longer middle class. It was pushed up a couple of notches, and that sort of possibility is never possible in fixed income. So this is not the time to run away from fixed income. This is the time to invest more into equity, because you need that chance, and you're going to take that chance. So my plan is to continue doing this. I'm going to wait a bit until my portfolio regains 60% equity, and once it gets to 60% equity, I'll rebalance 10% and make it 50-50 and use the Benjamin Graham kind of portfolio allocation, because I will be 46 this year. I mean, that will be the correct allocation for me, approximately that would be the allocation for some more time to come. It will be much more easier to manage. I'll be able to handle crashes much better because I'm getting older. So I have been very lucky so far to still be in this kind of a financially independent status, but that's just luck. I mean, I have the hard part now is the market will wait for the economic revival. That's going to take a long time until it sees some sign of good revival. Future returns are going to be good. It's not going to revive at all, in my opinion. For some time, for months and months, it's going to be a sideways market. So we'll have to be a little more patient. Hence, I want to have that cash holding of 10% to bolster my portfolio up. Let's see how things go. I'm not planned too much. Um, I have also not calculated or compared my portfolio currently with respect to an index fund. I will do it in the audit posts. I don't want to do it now. So that's the status. I'll catch you later. Bye bye.